Why would institutions want to invest into cryptocurrencies? In today's video, which is episode 1 of how to think like an institutional investor, I'm going to begin with simply the most basic topic of why would institutions want to invest into cryptocurrencies? After all, they're incredibly volatile, and as we know, they're one of the most risky investments around. So why would something like a pension fund, where the number one priority is to keep the money very safe, want to invest into this crypto space? In this video, that's a question that I'm going to be trying to answer as simply as possible. Remember that nothing in this video or on this channel is financial advice. I'm going to pop up the disclaimer here, so if you would like to pause the video and read it in full, please feel free to do so. The key takeaway is that nothing is financial advice, and you should always do your own research and make your own investing decisions. For many investors, they get very excited seeing headlines like this, which go, institutional investors will bet big on cryptocurrencies in 2018. And the whole article is basically explaining why institutions could potentially enter into cryptocurrencies in this year. There are other article headlines which say, for example, Thomson Reuters survey finds 1 in 5 financial institutions considering cryptocurrency trading in 2018. These two articles and many others like them sound very, very bullish for cryptocurrencies. They portray the idea that financial institutions want to get involved in cryptocurrencies because they see the potential in the market. Personally, I do find that exciting. What really interests me more and actually gives me more hope about institutions entering the market is something called the value of uncorrelated assets. There are many bullish aspects to cryptocurrencies which could potentially encourage institutional investors to invest in the cryptocurrency space. For example, will Bitcoin someday be a digital store of value for the whole world, similar to gold? Will Ethereum be worth more than any company around because it is the protocol layer for the decentralized world? These are questions which retail investors, people like you and me, are very excited by, and sometimes it's easy to think that the financial institutions will be as excited as us and therefore want to get into the crypto space. But when you're considering something like a pension fund, you have to think that the money inside that fund is for people's pensions. So the absolute worst thing you can do is lose that money. If you're investing into cryptocurrencies, it's so unbelievably risky that even though Bitcoin might be a digital store of value for the whole world, if it increases the risk you're taking and you could potentially lose people's pensions, suddenly it doesn't seem like it's worth that risk. That's the reason that when I see many bullish articles on cryptos, I'm nowhere near as excited compared to when someone puts forward the argument of the value of uncorrelated assets. I'm going to try and break down for you guys in this video why I believe that is so important and why it's going to encourage financial institutions to get involved in the crypto space. If you read the book Crypto Assets, you might well have heard this argument already, but I believe there's probably many people who haven't, which is why I want to put it forward today. I'm going to keep this explanation as simple as possible. The first thing you need to know is something called the Sharpe ratio, which is incredibly important when building a portfolio. The most common measurement of risk-adjusted return is the Sharpe ratio, a measurement that subtracts the risk-free rate from the return of an asset and then divides the difference by the standard deviation of that asset. So what does that all mean? Well, essentially, it's a measure of the potential return you can receive in relation to the volatility of that asset. So if something goes up and down by significant amounts, it's considered more risky because you might invest into it and lose 20-30% in a matter of just a few days, as we have seen with cryptocurrencies many times. If you have a higher potential return, then that volatility is somewhat more accepted. For example, if the asset could increase 10 times in the space of a year, then you would accept more volatility because after all, you would potentially be getting returns that are unheard of in other assets. But this is where it gets very interesting, and stick with me here because I am going to be explaining this throughout, of course. This is where uncorrelated revenue streams come into play, the key word here being uncorrelated. The risk-adjusted returns of a portfolio of 60% stocks and 40% bonds can be improved with the inclusion of assets with lower correlations, even when these assets have the same expected return and the same standard deviation of the underlying 60-40 portfolio. Basically what they're saying here is that by adding an uncorrelated asset to your portfolio, even if it performs the same as everything else in your portfolio, you've still improved your risk-adjusted return. You've improved your Sharpe ratio. The idea behind it is basically that you want as many uncorrelated assets as possible, because if you only have correlated assets, you could wake up and find that just about everything in your portfolio is down. If you only had stocks in your portfolio and they're all highly correlated, well, they're probably all going to move up and down as one. If you're running something like a pension fund, you can't take the risk that everything in your portfolio has going to have gone down. What you need is to be highly diversified across lots of different assets, and then to take that a step further to be highly diversified across lots of different uncorrelated assets. That way, over the course of a year, you might find that some of your portfolio has done very poorly, but the rest has done very well because they're uncorrelated. When one is going down, it doesn't mean the other one is as well. As a result, at the end of that year, even if your stocks have done terribly, potentially the bond market has done very well and your portfolio hasn't lost considerable amounts of money. The overall point here, and the really key important point when we're considering investing into cryptocurrencies, is that adding an uncorrelated asset to a portfolio can make it less risky, even if the actual asset itself is very risky. And cryptocurrencies thus far have proven to be uncorrelated to financial markets. So what I'm basically saying is that by adding cryptocurrencies to an existing portfolio, it can actually increase the potential return while reducing the risk. That may sound crazy because cryptocurrencies are so risky, but that's the key with uncorrelated assets. If you have a portfolio which is made up of 98% regular financial market investments, and then you simply add 2% cryptocurrencies, what you may find is that the risk-adjusted return or the Sharpe ratio has actually improved. Now, this may all sound kind of technical, kind of nerdy, but the importance of it really should not be overlooked. When financial institutions are making large investment decisions, they don't invest like retail investors like you and me. We kind of look at the market, have a gut feeling of whether something looks under or overpriced. With financial institutions, they are running many simulations and they are using a much more formulaic mathematical approach. So when the maths tells us that investing into cryptocurrencies can actually improve their risk-adjusted return, that is an incredibly bullish factor. I read several articles a week talking about why financial institutions are going to want to get involved in cryptocurrencies because of the incredible promise that the technology holds. And we all know that cryptocurrencies are going to be big in the next 10, 20 years. So that's why financial institutions would want to take that gamble. Personally, I'm not as sold on that idea. I am definitely sold on the idea though that simple mathematics tells them they should invest into the market. When you have the maths telling us this is a good investment, that is incredibly bullish for cryptocurrencies. That is the main reason that I'm confident it's only a matter of time before financial institutions are going to invest into cryptocurrencies in a big way. There are definitely already some financial institutions in this space. There's no doubt that there's a lot of trading going on over-the-counter markets, and financial institutions are buying in large sums, but certainly not in the way that we could see in the potential future. When funds like pension funds want to get involved in the market, that is billions that could flow into the crypto space. Hopefully this video, episode 1 of the Think Like an Institutional Investor series, should serve as the explanation for everything to come. After all, I can't really make a series talking about how we should adjust our portfolios for when the institutional money makes its way into the market without first explaining why I'm so confident that that money will make it into the market in the first place.